Most people don't realize it, but every time they swipe a credit card, someone is making money. And it's not just the banks. Two companies sit at the center of nearly every transaction: Visa and Mastercard. They don't lend money. They don't take on credit risk. They simply act as the toll booth for the entire global payment system. Now, here's the part that most investors miss. Over the past 2 decades, these two stocks have consistently outperformed the market, delivering annualized returns of 12 to 30%. But there's a way to make those returns even better without taking on unnecessary risk. In this video, you'll learn a simple strategy to maximize your investment in Visa and Mastercard. By making small adjustments based on valuation, you can capture returns of 12 to 20% annually while avoiding common pitfalls. This isn't about market timing, it's about knowing when to buy more and when to hold back. Visa and Mastercard are financial powerhouses. Together, they control nearly 90% of the global payments market. No serious competition, no major disruptions. Just a near monopoly on how money moves worldwide. And their profitability is staggering. Visa operates with a net profit margin of around 50%. Mastercard isn't far behind at 45%. These numbers rival the most exclusive luxury brands, companies like Ferrari or Hermes. But unlike luxury goods, payment processing isn't a niche market. It's everywhere. And it's only growing as cash disappears and digital transactions take over. Since their IPOs, both stocks have crushed the S&P 500. Yet, despite their incredible performance, many investors fail to take full advantage of them. That's where this strategy comes in. It's not about trading constantly, it's not about guessing market movements, it's about adjusting your investment weight when opportunities arise. Because history has shown something fascinating. Every time these stocks take a big hit, they come back stronger. And those drops? They're the best buying opportunities. If you know when to buy more and when to hold back, you can maximize returns without adding complexity. It's a simple, powerful way to grow wealth over the long term. And here's how it works. The key to maximizing returns with Visa and Mastercard isn't about constantly trading or chasing short-term gains. It's about understanding their valuation and adjusting your exposure accordingly. These companies are long-term compounders. Completely exiting a position is almost always a mistake, but keeping the same allocation at all times regardless of valuation isn't the most efficient approach either. The goal is to stay invested while taking advantage of moments when these stocks are either undervalued or overvalued. So how do you know when to adjust? One of the best indicators is the price-to-earnings, PE ratio. Historically, Visa trades between 20x and 40x earnings, while Mastercard tends to have slightly higher multiples ranging from 25x to 50x. When their PE ratios drop near or below their historical averages, around 25x for Visa and 30x for Mastercard, it's usually a strong buying opportunity. Another key factor is earnings growth. Both companies consistently grow their earnings per share, EPS, by 20–30% per year. If the stock price drops but earnings growth remains strong, it's often a signal that the market is overreacting. Free cash flow, FCF. Multiples are just as important. Visa and Mastercard typically trade at 25x to 35x free cash flow. If this multiple falls below 25x, it has historically been an excellent entry point. And then there are market corrections. History has shown that every time Visa and Mastercard drop by 25–40% due to external shocks, they bounce back even stronger. Look at past crises. 2008 financial crisis, Visa dropped 52%, Mastercard 62%. 2020 COVID crash, Visa down 36%, Mastercard down 40%. 2022 interest rate hikes, Visa fell 28%, Mastercard 30%. Each of these crashes turned out to be prime buying opportunities. Those who increased their positions during these downturns saw massive gains in the following years. So how do you apply this to your portfolio? When Visa or Mastercard drop by 25% from their highs, it's time to start adding more. If they fall by 35% or more, it's an even stronger signal to increase your position significantly. In extreme crashes, 50% or more, going all in has historically yielded incredible long-term returns. But what about selling? If these stocks trade well above their historical valuation ranges, above 40x earnings for Visa or 50x for Mastercard, it may be time to trim the position slightly. Not to sell everything, but to reduce exposure and wait for a better opportunity. This strategy is simple but powerful. It ensures that you're always invested in two of the best companies in the world while optimizing returns by adjusting your allocation based on valuation. And when executed correctly, it can turn a great investment into an extraordinary one. Buying Visa and Mastercard during corrections is one of the most effective ways to maximize long-term returns. But what happens after you've built your position? How do you ensure consistent, market-beating performance without overcomplicating things? The answer lies in a simple yet powerful allocation strategy, one that captures 12 to 20% annual returns while keeping risk under control. If you do nothing and simply hold Visa and Mastercard for the long term, reinvesting dividends, history suggests you can expect 12 to 15% annualized returns. That alone is enough to outperform most investors. But by making small strategic adjustments, buying more when valuations are low and trimming when they become excessive, you can push returns even higher into the 18 to 20% range. The key is weighting your investment correctly. When valuations are within their normal range, around 25 to 35x earnings, keeping a 50-50 split between Visa and Mastercard is ideal. This ensures balanced exposure while benefiting from both companies' strengths. If one of them experiences a sharper decline, say a 25-40% drop, you shift more capital into the weaker performer, increasing its weight to 60-70% of your position. This simple tweak ensures you're always taking advantage of mispricing. When valuations become extreme, above 40x for Visa or 50x for Mastercard, you reduce exposure slightly, dropping the allocation to around 30-40%. Not selling everything, just holding back some liquidity for future opportunities. And in a major market crash, like 2008 or 2020, you go all in. Historically, increasing exposure to 80-100% during these moments has led to the highest long-term returns. A simple buy and hold strategy with Visa and Mastercard would have turned a $100,000 investment into around $310,000 after 10 years. Not bad. But adjusting weights based on valuation, that same $100,000 would have grown to $547,000. And for those who aggressively bought during deep corrections, the result would be closer to $619,000, more than 6 times the original investment. Visa and Mastercard are two of the best long-term investments in the stock market. Their near monopoly, high profitability, and structural growth make them unbeatable wealth-building assets. The best approach is to always stay invested but adjust your position based on valuation. Buy aggressively when prices drop. Trim exposure when valuations get extreme. Never sell out completely. This strategy is simple, low risk, and highly effective. It's not about trading, it's about positioning yourself for the highest long-term returns. If you found this valuable, make sure to like this video and subscribe for more strategies on smart investing. And let me know in the comments, do you already own Visa or Mastercard? How do you manage your positions? And remember, the sooner you start optimizing your investments, the faster you'll build real wealth. See you in the next one.